You may have heard about it already. The One Big Beautiful Bill is now law. And while Washington buzzes with political headlines, what really matters for you is this. This bill just made sweeping changes to the tax code that could seriously impact your retirement. But here's the good news. If you're clever about it, this new tax law could be a major opportunity. I'm JB Howard, Senior Financial Advisor, as well as founder and president of Merit Advisors LLC. And I'm here to break down the implications of this new legislation.
Merit Advisors, helping improve lives by making ideal choices.
Three of the major highlights are several provisions from the 2017 Tax Cut and Jobs Act, including lower income tax brackets and a higher standard deduction, were just made permanent. The estate tax exemption is now $15 million per individual or $30 million per couple. And there's a brand new tax deduction for retirees age 65 and older, $6,000 per person or $12,000 per couple, which can offset taxes you might otherwise pay on your Social Security benefits. But keep in mind, this deduction is temporary and will only be available through 2028. Many professionals consider the current tax environment to be favorable compared to historical rates, and that's incredible news for you as an investor and as a retiree. But you've got to be wise right now. Lower income tax brackets were just extended permanently, but in Washington, permanent means until Congress changes it. Historically, low tax brackets don't last forever. In fact, Congress has revised individual tax rates several times in recent decades. And with rising national debt, growing Medicare and Social Security costs, along with shifting political leadership, there's strong reason to believe tax rates could rise again in the future, especially for higher earners. That's why this moment matters. Now, let's get into some other key parts of the bill that could impact you and your family. The standard deduction amounts have increased and are permanent for now. $15,750 for singles and $31,500 for married couples filing jointly in 2025, plus that extra $6,000 deduction if you're 65 or older, with income limits that reduce this benefit if your income exceeds $75,000 single or $150,000 jointly. There's a new temporary deduction for car loan interest up to $10,000 annually, but only for vehicles assembled in the U.S. and with income phase out starting at $100,000 single, $200,000 married. Now this runs through 2028. Effective in the 2026 tax year, itemizers who make charitable contributions will only be able to claim a tax deduction to the extent that their qualified contributions exceed 0.5% of their adjusted gross income. For example, a couple with an AGI of 300,000 could only deduct charitable donations in excess of $1,500. So high-income individuals who itemize deductions should carefully consider the timing, the amounts of their giving, and the strategies to maximize their deductions. For example, a bunching strategy or an approach of making larger gifts with less frequency can be more effective under the new rules, possibly a donor-advised fund. This donation must be made in cash. This includes donations made by check, credit card, or bank statement, but excludes gifts of property or other assets. The donation must be made to a qualified charity. The recipient organization must be an IRS-recognized 501c3 public charity. Estate tax exemption increases to $15 million in 2026, adjusted for inflation from there. Now, bonus depreciation returns to 100% for qualified assets placed in service after January 19th of 2025, which could be valuable for rental property owners. Here's some important deadlines. Electric vehicle tax credits end September 30th of 2025, and energy efficient home improvement credits expire December 31st of 2025. Temporary deductions from 2025 to 2028 include no federal income tax on tip income, all the way up to $25,000 annually, and a deduction up to $12,500 for overtime pay, both with income phase outs. And the state and local tax deduction, or SALT cap, as it's known, jumps from $10,000 to $40,000 in 2025, rising gradually until 2029 before reverting in 2030. Now, let's get to the bottom of Social Security taxation under the new One Big Beautiful Bill. What has not changed? The fundamental formulas for taxing Social Security benefits remain exactly the same. The old 50% and 85% taxation thresholds for Social Security income still apply as they always have. Now, if your combined income is below certain levels, you pay no tax on Social Security benefits. If it's higher, up to 85% of your benefits can be taxable. The new law did not eliminate or reduce Social Security taxes directly because changes in Social Security taxation are generally prohibited by the Byrd Rule and reconciliation legislation. Now, Medicare premiums and their taxation rules also remain unchanged. What has changed, indirectly and temporarily, is the bill introduces a new temporary bonus deduction for taxpayers. Again, age 65 and older, starting in 2025 through 2028. This gives seniors an additional $6,000 deduction or $12,000 for couples subject to income limits. This deduction is designed to provide some tax relief that helps offset the taxes older Americans pay on Social Security, but it does not change the underlying Social Security tax rules themselves. In summary, Social Security tax rules are unchanged, but seniors get a new temporary deduction that can reduce their taxable income and help offset Social Security taxes. All of these details add up to a tax landscape that offers you powerful tools, but only if you use them wisely and in time. Now, what should you do with this information? The reality is the tax door is open for now, but it won't stay open forever because tax laws just changed. And for those who are proactive, this could be a perfect moment to help reduce future tax burdens and preserve what you've worked a lifetime to build. Thank you so much for taking the time to listen, and I hope you enjoy the rest of your day.